How would you determine when a trade has failed other than performance entry?
That's a really good question because it brings in an intuitive element in that the technical structure is incorrect. I try and ignore that at times. For example, I'm long of a little company, a company called AB Dynamics. It's a minnow in the London stock market. And it was moving up the page and it was creeping up the page, and my stomach told me this doesn't look good. And of course, it broke out of that creeping formation yesterday and it flew up the page. So it's a very good question that. I'm reasonably clinical there. We have some rules. One, start with a very small position with a stop loss well out of the traffic. Okay, and I base my stop losses on a technical thing called average true range, but that really doesn't matter. I don't like to give away any more than half my profit. So if I'm in a forex trade, I was up 200 points and it pulls back. For example, I was short the pound against the dollar 2 weeks ago. The same time as I got stopped out of the Dow trade, I was short the pound against the dollar from 26.10. Flew down the page, I was up 300 points, and it then zoomed back up the page again. I got out at 150 because I had this rule of not giving away any more than half my profit. So I think that's something that's good. I have a product called Vector Vest, and within the product there's a 5-week training course, and week number 2 is all about exits, and I cover that in a 30-40 minute video. It's not me, I've had somebody like yourself voice over it professionally.
Do you ever average down on a losing trade?
No, not for years, and that was one of the things that I resolved to do when I sat on that mountain outside Johannesburg. However, I know people who do, but they do it in a very careful way. They say that it's very, very difficult, especially in the forex market, to get their entry spot on. So they will average into a trade. So rather than risking that 0.5% on one trade, they will go in at a quarter, and then if the market gives them a better level, they'll go in at a quarter again. But they then define that the total risk on that trade should not be more than 0.5%. So they split their entries. Mathematically, that is quite a good way to think about it. I don't like it because it breaks the discipline. It's like going on a diet and just having one beer. Okay, it just breaks the discipline. I don't know what you're like, but you know.
This pretty much sums up my day, yeah.
So one chocolate biscuit and you're finished. Okay, so as far as I'm concerned, I don't do that. But I know an awful lot of traders who are exceptionally good traders that in fact split their entries. Some split their entries based on price levels. Some split their entries based on time. In other words, if the market pulls back, they'll buy a little bit, and then 3 or 4 hours later, if it hasn't moved, they'll buy a little bit again, and they will split their entries based on time. But the trick is that the risk of all of the positions must not be any more than that 0.5% that I talked about, although I don't do that myself.
So we've heard about what you will accept in terms of a loss before you'll close out. What about when you're winning? How long do you let it go before you take your profits?
I think that you can wrap up entries fairly quickly, but exits are really, really difficult. A lot of exits, of course, are a part of your individual trading plan. There's no right, there's no wrong. I think that you really need to know where you're going to get out as you put the trade on, when you're right and when you're wrong. Now, it could be something as simple as trailing a stop loss up behind you, and largely in the stock market, in shares that are growing their profits aggressively and safely, that are rising, I will certainly trail a stop loss up behind them, a ratchet stop loss that locks in some profit. In the stock market, I'm very wary of when the general market turns down, and I have a signal in the general market that tells me that the general market is falling. It's called a confirm call, and I get a confirm call up, a confirm call down. Very, very strong signal that tells me when the general market is falling based on price and based on market breadth. And I have every evening I look at all of the companies in the London market that are rising and all the companies in the London market that are falling, and every day I keep up to date, and it's done automatically, what I call the buy-sell ratio, which is a measure of the breadth of the market. Certainly, if the general market starts to fall, then I shall start to ease out of certainly some stocks that haven't performed on the way up, or the small caps. You've got to be very careful with small caps when the general market falls, because they are invariably bid up by small traders, and when the sentiment of the market turns, all those small traders go away, and you'll find that the bids just disappear. So for example, I've done really well in a little company called Sophion recently. I bought it at £3, it's pushing towards 5, and that's in 6 weeks. Sophion and that absolute dynamics that I talked about, small caps, I think that I need to be very careful there, because if the sentiment, the Trump trade were to disappear, and I think it's getting mature, if that were to disappear, those bids can go, and I'm going to find it very, very difficult to get out. In the Forex market, you could look at something like old highs. I think as a short-term trader, you need to be selling into strength, into some form of strength. I myself look at Fibonacci levels for exits, and namely Fibonacci extensions. When the market pulls back, it tends to run to a 1.618 extension of the last pullback. So I'm looking at Fibonacci levels to sell into those Fibonacci levels. And if I can get in on a pullback and sit and add onto a 1.618 extension, and then start to ease out of the position up there, then I'm quite happy with that.
So you're obviously a very passionate trader. How about investing? Is that something you're interested in?
Well, yes. I have a portfolio of stocks, and if the general market keeps going up, and they keep going up, then I'm going to hold on to them for as long as they keep going up. I'm very happy with them, but I am a trader, and I probably have made the mistake of getting out too quickly of some investments that have gone up the page. I've held JD Sports, for example, from £3 right up to £15. They've just had they had a 5-for-1 split, but that's going very well. I've held that up, and I've added to that enormously. In fact, I've got a problem there, because I've added to it that I've actually got a disproportionate part of my portfolio in that one particular share, and I need to rebalance. That is something that needs to be done fairly quickly, although it's a grand wee problem to have.
Yeah.